at 1,500 and it went to 1,900. At the same time, Treasury bonds started to rally, also end of June, and the TLT, which is essentially a 20-year government bond fund, rallied from 95 to a high of 112. And recently, in the last couple of days, both bonds, U.S. Treasury bonds and gold, have been going down at the same time. This is in a way very illogical, because you would want to be in bonds in a highly deflationary environment, and you would rather want to be in gold in an environment where you think that money printing will drive up prices eventually.
Well, it seems perfectly rational, Marc Faber, because we've got both, right? You can find people that tell us that we're going through a deflationary spiral, and those that are telling you, go look at the gasoline and healthcare prices, and we're going through an inflationary surge.
Yeah, sure. Look, a lot of things don't make perfect sense because the markets are rigged. I'm not saying they're rigged by purpose, but artificially low interest rates lead to very high economic and financial volatility. And with the intervention, the Keynesian economics, you basically have more and more regulation and more patchwork that create, again, volatility in markets.
Marc Faber, you mentioned interest rates. Is it a useful metaphor to think of it as a pressure cooker that eventually interest rates are going to explode? Or are the markets as rigged as you suggest and interconnected to the point where it'll be a slow creep up in interest rates?
Well, I think initially they could go up quite a bit here, maybe on the 10 years to around 2.5%, 3%. We're now at 2.27%, and then creeping up. Interest rate cycles are long cycles, like commodity cycles, and I happen to think that we are near the low, the trough of the interest cycle bull market, and that from here onwards will go higher.
What is your take on the Fed's strategy right now?
On the strategy of whom?
On the Fed.
On the Fed. Well, I think that Mr. Bernanke did the right thing. He didn't announce a QE3. But if I look at the explosion in money supply, M1, recently, and also M2 and M3 growing at an accelerating rate, then I think we have a silent monetization that is already occurring. And at the September meeting, I think some measures will be announced unless economic statistics would suggest that the economy is rather stronger than has been perceived. Recently, the statistics have been weaker than has been expected.
Marc Faber, a question from a listener, and he knows that you're a world traveler. I don't know, how many frequent flyer miles have you managed to accumulate so far?
Well, I don't know. I don't count them, but I have a lot of them. But each time I want to redeem them, the airlines say, you can't do this, you can't do that.
You see?
That flight is fully booked, that flight is fully booked.
That's right.
It's a racket like Wall Street.
Well, all right. So there you go. So given the fact that you spend your time up in thin air a lot of the time, the question is, do you know or a specific country that currently embodies what he describes as the characteristics of the concept of America today? He suggests that Singapore is one that many people describe.
Well, I think that you have in Asia countries where you may not have a perfect democracy, whereby I would question the perfect democracy in America also, but at least we have a lot of personal freedom and business freedom. In other words, regulation is minimal, the intervention by governments are relatively light, and the economies therefore grow relatively rapidly. In addition to that, we had in Asia a financial economic crisis in 97-98, and thereafter we had a period of deleveraging. In other words, the overall debt level in the system, government debt, private debts, household debts came down. And this hasn't happened in the Western world. In fact, in the Western world, what caused the crisis is excessive leverage, excessive debt, excessive credit. But the healing process is to actually create more credit, but this time by the governments.
What emerging markets are you liking?
Well, I mean, in Asia, I wouldn't consider Singapore, Hong Kong, South Korea, Taiwan to be emerging economies any longer. But these economies, I think they will outperform the U.S. in the long run. In terms of emerging economies that I like, I would mention Thailand is not a very dynamic economy, except possibly at night. And India, I think India has a significant growth potential. My worry about Asia is more of a geopolitical nature. The tensions between India and China are growing. Increasingly, we have unrest in Pakistan and a dysfunctional government. And so I would be, for that reason, relatively careful about investing right now heavily in Asia.
Marc Faber, I want to take you back to a time when you attended a speech by Sidney Homer. That name might not ring any bells for some listeners, but it really should. He's the author of a book entitled A History of Interest Rates, 2000 BC to the Present. Yes. I know that you carry that book with you everywhere you go. You know, you put it on your bedside table.
Yes.
Tell me about Sidney Homer and why people ought to at least acquaint themselves with him.
Well, I think he represented the old school of Wall Street investment bankers that were partly researchers and partly businessmen and had an enormous sense of integrity, because Wall Street in those days, whether it was Salomon or Goldman Sachs or Whitewell or Smith Barney or First Boston, were basically partnerships. And of course, within a partnership, it's viewed very badly to cheat somebody else, and especially to expose the firm to excessive leverage. So the partnerships were run very differently than the modern corporation that was run essentially by people and traders that had all the upside, but if something, and got huge bonuses, but if something got wrong or went wrong, they didn't have any downside. So obviously it encouraged a culture of risk takers and irresponsibility.
Marc Faber, last question for you. This has to do with access, because you know that there are a lot of young people who want to learn about markets, they want to learn about the financial system, and they may feel that the only way they can learn is by going online. You make the point that smart, intelligent, experienced individuals might actually be accessible. Explain what you mean.
Well, I think if someone calls me or someone wants to meet me, I can tell him, look, when I'm in Chiang Mai, I'm at 6 o'clock in Linda Bar, because I always have a cocktail there. And if you want to stop by and meet me, you can meet me there, but obviously not for a lecture in economics and in financial markets, but we can meet socially.
Is that lacking in today's marketplace, job market, as well as in professional world?
Well, I'm extremely bearish about employment in the financial sector. I think it's a huge overcapacity that we have in financial services, and most of the participants in the financial markets are actually not creating any GDP growth. In other words, they just trade against each other, and that doesn't create any wealth. So I think that employment on Wall Street and in banks and so forth will contract over the next few years by at least another 30%. So rather than to go into Wall Street to make money, I would go like I went in the 70s into Wall Street at the horrible time. The market in 1982 was lower than it had been when I joined Wall Street in 1970. But I did it because I was interested and have always been interested in watching price move up and prices move down, whether it's for commodities, bonds, equities, real estate, art, or whatever. I was just always fascinated by market movements.
I want to thank you very much, Marc Faber. He is the publisher of the Gloom, Boom, and Doom Report. Always appreciate your insights joining us.